So that's why the new 15% performance in the S&P is, in my opinion, not stellar. I mean, you got to beat that index to justify your existence as a fund manager. Otherwise, may as well just buy the S&P. Hey guys, listen up. Kareem Babe here. Most people think that capital market performance comes from innovation and corporate earnings. But what if I tell you that the main drivers over the last 15 to 20 years since 2008 has been the government debt. Yes, the deficit that we're running. So when the US government runs deficit, which we're getting accustomed to, obviously, if there's one thing the two parties agree upon is running deficit indefinitely, apparently. Nobody's stopping them. So we raise more debt to fund our deficits, running at $2 trillion a year, which is mind-boggling. But then the demand for that is actually finite, right? So what happened is that's where the Federal Reserve steps in to monetize the debt or to fill in that gap, especially if major power max out and buying out treasury or having enough exposure to the US dollars. So the Fed balance sheet comes in, and there's other mechanism that actually flows that money that we are creating to find itself into the capital market. So technically, we are just witnessing the monetization of our debt via various instruments. So you see some of that held by foreign governments. Other stuff is held by the Federal Reserve, which has its balance sheet massively ballooned over the last 17 years or so. It's close to $8 or $9 trillion. Some may say even eventually it's going to go to $100 trillion, God forbid. And then obviously the rest is monetization via the equity capital market and various assets. So you're not seeing that directly to the inflation. So a lot of people think, oh, if you're printing money and the government is running a deficit, and therefore we see it in the inflation, but we see it in the inflation of assets. So that's why the new 15% performance in the S&P is, in my opinion, not stellar. I mean, you got to beat that index to justify your existence as a fund manager. Otherwise, may as well just buy the S&P or buy the Magnificent Seven. I'm caveating this also. Look, we're going through an AI, so it's similar to the .com. So a new way for us to interact with each other is going to emerge. So the new way of doing business, similar to what the internet did throughout the 90s. We're going to see that in the AI, obviously, but we also know what happened to the .com when the music stopped. So I'm not predicting that AI eventual correction will happen. But look, we got to take into consideration all factors. I mean, but my take here is, look, if you're an investor or retail investors, you're looking at your 401k, a 15% CAGR when the government is running to $2 trillion deficit, when the Federal Reserve money printing is going to be almost indefinite. It's not going to enable you to increase your purchasing power. I think I ran a video about a month or two ago showing that you need to at least have a return of 18% over your money just to stay afloat. So 50%, you're losing roughly 3%. Put some thoughts into it. I know it might be kind of sound controversial to some, but I've done the work and I've been doing this for 20 years. So if kind of felt like I need to talk about it, just, I feel it's very important for us to kind of not be swayed by the narrative, but look at the data. Don't forget to subscribe to our channel, obviously. And please, if you have any comment, link it below so we can keep it engaging. Till then, have a wonderful day.